If there's one myth humanity refuses to let die, it's the charming bedtime story that the gold market is free. You've heard it before, whispered by economists who haven't touched a bar of gold in their life, repeated by investors who confuse trading apps with reality, and shouted by commentators who swear that price is simply the product of supply, demand, and a sprinkle of rationality. Because of course, it is. And the moon is made of cheese, markets never lie, and governments would never, ever manipulate anything as sacred as money. Let us get one thing straight from the beginning. The gold market is as free as a marionette dangling on a string. The only question is who holds the strings and why everyone pretends not to see them. To understand this illusion, you have to appreciate the genius of its design. Gold has always been marketed, quite ironically, as the ultimate symbol of independence. It's a store of value no government can print, no corporation can duplicate, and no regime can easily confiscate. In the public imagination, gold is the final escape hatch from the artificial world of fiat currencies. Those dollars, euros, and yen we carry around. And yet, despite this widespread romanticism, the price of gold moves in ways that would make even the most naive observer stop and ask, wait, how is this possible? But most people never ask. The illusion works because it is elegant. Consider the London gold fixing, a system so ancient and opaque that it somehow survived the modern world's obsession with transparency. Every day, a small group of financial institutions, with perfect calmness and supposed wisdom, gathered to fix the price of gold. Nothing strange about that. After all, price fixing is only illegal when ordinary companies do it. When banks do it, it's tradition. Ah yes, tradition. Favorite word of institutions that no longer want to justify themselves. Of course, the defenders of the system will tell you that this process ensures stability, consistency, liquidity, and other comforting words that sound like they were lifted from a central bank press release. But let us be honest. The idea that a handful of banks can determine the daily benchmark price of one of the world's most important commodities, and yet this constitutes a free market, requires a level of gullibility that is almost admirable. But the London fix is just one layer of the illusion. The real trick is much more subtle. Enter the vast, shimmering world of paper gold futures, contracts, derivatives, and other beautifully complicated instruments invented to convince the public that they own gold when they really own a promise. It is the triumph of modern finance. The ability to sell something that does not exist backed by gold that may or may not be in a vault guaranteed by institutions that have every incentive to keep the illusion alive. The scale is breathtaking. For every ounce of physical gold that exists, several dozen, sometimes hundreds of ounces of gold paper circulate freely. This miraculous multiplication of supply has an extraordinary effect. It keeps the price of real, physical gold curiously low. Supply and demand, after all, work very differently when supply can be manufactured out of thin air. But surely this is still a market, right? Just a more sophisticated version. Well, if you define a market as an arena where the strongest players make the rules as they go along, then yes, the gold market is exceptionally sophisticated. The beauty of the illusion lies in the timing. Every time panic grips the world, a bank failure, a geopolitical crisis, a debt ceiling standoff, there is a predictable surge in gold prices, followed by an equally predictable, utterly inexplicable crash. It's almost as if someone, somewhere, doesn't want gold to behave as a true safe haven. Almost as if letting gold rise in proportion to risk would send the wrong message that fiat currencies aren't as stable as governments would like people to believe. Imagine the catastrophe. People losing faith in paper money. People choosing to store wealth outside the financial system. People demanding something tangible instead of digits on a screen. The horror. No. That must never happen. And so, like clockwork, just as gold begins to reflect reality, massive sell orders appear not over hours or days, but in seconds. Thousands of contracts dumped in moments that magically coincide with low liquidity hours. A coincidence? Surely. Market forces? Undoubtedly. Bad timing, obviously. After all, manipulation is just a conspiracy theory. except for the dozens of cases where major banks were fined for manipulating the gold market. But who keeps track of those headlines? The defenders of the official narrative will tell you that gold is a primitive relic, irrelevant to modern finance, overshadowed by sophisticated monetary instruments. If that were true, you might ask, why do central banks still hoard thousands of tons of it? Why do they quietly buy more whenever geopolitical tension rises? Why did they collectively become net buyers for more than a decade? Why do they guard vaults full of a metal that supposedly no longer matters? There is a simple answer to that. Gold matters. It matters more than any official institution will ever publicly admit. And that is precisely why its price cannot be allowed to roam free. A truly free gold market would be a referendum on global monetary policy, a brutally honest scoreboard of inflation, debt, and geopolitical instability. And honesty is the last thing the financial world is built for. You might think, then, that investors would be outraged, that people would demand transparency, audits, and reforms. But they don't. The most extraordinary part of the gold illusion is not the manipulation itself, but the fact that no one wants to break the spell. The financial system needs the illusion to survive. Governments need the illusion to maintain confidence, and many investors need the illusion to believe they understand what they are buying. And the world simply moves on. There is, perhaps, no greater irony than this. The asset most celebrated is real, solid, and immutable is priced in the most unreal, abstract, and manipulable way possible. A metal that outlasts empires is, in the modern world, controlled by institutions that cannot balance their own balance sheets without emergency interventions. So yes, let us continue pretending the gold market is free. Let us continue believing that price is truth, that transparency is optional, and that volatility is just the cost of doing business. Let us nod wisely when analysts explain away every suspicious price movement with sophisticated jargon, because, in the end, illusions are comforting. Comfort is far more valuable to modern markets than honesty. Welcome to the gold market, where nothing is as it seems, and everything works exactly as intended. Ever wondered what really moves the price of gold? If you think it's just traders and big banks, you're only seeing the first floor. Let's go up to the penthouse, where the real architects of the financial world live. Central banks, they don't call it intervention. That would be too direct, too honest. They prefer softer terms, like stabilization or managing market confidence. These sound responsible, even boring. But behind these harmless words are actions that reshape global markets without leaving a single fingerprint. Central banks are masters of narrative, and to understand the illusion of the gold market, you have to understand how they operate. Silently, indirectly, and with massive consequences. Let's start with a little accounting magic. Central banks love to talk about their gold reserves. They flash the numbers in reports and speeches as a sign of strength and stability. But here's the catch. A lot of that gold isn't actually sitting in their vaults. It's been leased out, swapped, or used in complex transactions that would make your head spin. But according to their rules, leased gold still counts as official reserves. So, gold that's physically gone is still reported as if it's there. It's a brilliant trick, one that only an institution that can't go bankrupt could pull off. And isn't it ironic? The very institutions that call gold an outdated relic are the ones manipulating it, precisely because it's still so incredibly powerful. If gold really didn't matter, why would they spend decades conducting its price like a symphony orchestra? So, how do they do it? One of the cleanest methods is gold leasing. Most people have no idea this even happens. Central banks quietly lend their gold to large bullion banks at incredibly low interest rates. The official reason is to enhance market liquidity. But what that really means is it allows these banks to sell gold they don't technically own, creating a flood of artificial supply on the market. This surge in supply naturally pushes the price down. It's the perfect crime. The central bank never officially sells its gold, so it can claim it's not manipulating the price. They just lend it out and let the market do the dirty work. No direct intervention, no public record, no fingerprints, just a flawless illusion. Have you ever noticed what happens when gold starts to spike during a crisis? Whether it's a banking scare, a war, or rampant inflation, gold will shoot up. And then, just as suddenly, it will get slammed back down. Violently. Illogically. It's as if someone, somewhere, flipped a switch. But no one ever admits to it. You won't see a press release from a central bank saying, "We just sold gold to stop the panic." The International Monetary Fund doesn't report it, and the Bank for International Settlements, or BIS, writes reports so vague they could mean anything and nothing at the same time. This coordinated silence isn't an accident. It's a feature of the system. Every central banker knows that gold acts like a mirror, reflecting the health of their paper currencies. If gold's price rises too fast, it signals a loss of trust in the very system they're tasked with managing, and that's a fire they cannot let spread. So, the invisible hands must step in to regulate the reflections, smooth it out, contain it, and keep gold in its place. It's a threat, but a neutralized one. Now, let us talk about one of the most successful psychological operations in modern finance. The strong dollar policy. You've probably heard U.S. Treasury officials say it in press conferences. We support a strong dollar. It sounds like a simple statement of a goal, but it's really a declaration of strategy. A strong dollar requires a stable, predictable gold price. Gold can't be allowed to rise too aggressively, because that would send a signal that the dollar, the foundation of the entire global financial system, is weakening. So for decades, the gold market has been carefully choreographed to reinforce the story that fiat currencies are stable and reliable. Central banks participate in this, not out of some evil plan, but out of necessity. Their job is to preserve faith in the monetary system. Gold just happens to be the collateral damage in that mission. If the illusion of a strong dollar cracks, the whole system starts to shake. So where do all these central bankers coordinate their plans? Enter the Bank for International Settlements, the BIS, located in Basel, Switzerland. This quiet, secretive institution is essentially the central bank for central banks. It's the strategic command center where guidelines for gold leasing and currency management are decided. The BIS likes to describe its work in very bland terms, like market functioning support. But behind closed doors, it's a story of shared interests and coordinated actions, all designed to make sure gold never sends the wrong message to investors. When the world's most powerful financial figures get together, you can be sure that gold is on the agenda, even if it's never mentioned in the official minutes. They are the keepers of the playbook. Here we arrive at the ultimate irony. Central banks are the loudest cheerleaders for free and fair markets. Yet, they are the biggest, most influential players in the gold market themselves. They set interest rates, which directly impact gold. They lease gold to manipulate supply. They issue statements to steer investor sentiment. They work with bullion banks to manage volatility. And they use complex financial instruments that never even appear on their public books. All of this while insisting that gold is an irrelevant, outdated asset. Think about it. They say gold is irrelevant, yet they actively manage its price. They call it outdated, yet they guard their reserves like national treasures. They claim it has no role, yet they panic whenever its price gets too high. It's like a politician claiming they don't care about their opponent, while secretly running a whole team to spy on them. This brings us to the two different stories about gold, the public story and the private reality. Publicly, central banks portray gold as a historical artifact, something for a museum. Privately. They treat it as the ultimate checkmate piece in the game of global finance. One asset that can expose the fragility of the entire fiat currency system. This is why the illusion must be maintained at all costs. A stable, predictable gold price creates the appearance that everything is under control. It suggests that inflation is manageable, government debt is sustainable, and our currencies are trustworthy. But a rising, uncontrollable gold price shatters that narrative completely. So the invisible hands stay busy, suppressing panic and managing expectations. They don't use brute force, but subtle mechanisms that the average person never even notices. The result of all this is a gold market that doesn't reflect reality. It reflects policy. Gold is not a free market. And it's not because of everyday traders or hedge funds. It is because the most powerful financial institutions in the world have too much to lose to let gold tell the truth. If the price of gold truly reflected the real state of the global economy, the mountains of debt, the printing of money, the geopolitical instability, the illusion of stability would crumble overnight. And so, central banks do what they do best. They control without appearing to control. They influence without ever admitting it. They shape the market without ever leaving a trace. These are the invisible hands, the quiet custodians of the great gold illusion. If physical gold is the anchor of monetary truth, then derivatives are the scissors used to cut the rope. Paper gold like futures, swaps, and leveraged contracts is where the illusion of the market doesn't just exist, it thrives, and like any grand illusion, it relies on overwhelming, absurd, completely disproportionate size. Welcome to a world where the amount of gold traded every day is so massive that it could impossibly exist in physical form. That is, unless someone secretly invented teleportation and infinite mining machines. But for the architects of financial engineering, physical reality doesn't matter. Perception does, and derivatives are designed to reshape perception with surgical precision. Let's start with a simple, almost hilarious truth that no one really wants to say out loud. The global market trades dozens of times more paper gold than the world could ever physically supply. For every single ounce of gold sitting quietly in a vault, there are 20, 30, so metimes even 100 ounces promised to investors, institutions, and funds through futures contracts. In other words, the entire gold market is built on IOUs, stacked on more IOUs, all wrapped in promises that can never be fulfilled at the same time. But don't worry, the system insists everything is fine. Why? Because, they say, most investors never actually take delivery. What a stunningly convenient assumption. Imagine a bank telling you, technically, we don't have your money, but it's okay, most people don't withdraw it all at once. That exact sentence has started revolutions. But in the gold market, it's just considered standard practice. This sheer scale of paper gold gives financial institutions a toolbox so powerful that the physical market becomes a mere footnote. So how does this work in practice? When the price of gold starts rising a little too quickly maybe, investors are sensing some trouble. In the global economy, the futures market springs into action. And not gently. It's like aiming a fire hose at a candle. They flood the market with sell contracts, increase short positions, and expand the open interest to levels far beyond anything remotely tied to physical availability. And the result? The gold price sinks all without a single bar of physical gold ever changing hands. It's a miracle, really. Supply is literally created from thin air, used to crush demand that was built on actual money. This is the beauty of futures contracts. They allow enormous supply to appear instantaneously. It's like a magic trick where the magician isn't even trying to hide the wires. The illusion becomes complete when analysts and commentators call it things like market corrections, technical adjustments, or macro positioning. But the mechanism is far simpler. Paper beats metal, because someone designed the game that way. Now let's get into the real theatrics de notorious short bombing. This is a maneuver so spectacular, it would be funny if it didn't wipe out billions in market value in just minutes. Short bombing is simple. You dump a massive volume of sell orders into the futures market at strategically chosen moments, usually when liquidity is at its lowest. Think about late-night trading sessions, during holiday markets, or right before a major economic announcement. They drop a mountain of paper gold on the market when no one is around to resist it. They watch the price fall violently, let the trading algorithms amplify the panic, and then they buy back their positions at the new, lower levels. Profit. This isn't speculation. This is design. But mainstream commentators almost never call it manipulation. No, it's always unexpected volatility, or algorithmic misfires, or my personal favorite, a response to shifting macro sentiment. Because apparently, investor sentiment just collapses at 2:17 in the morning for no reason at all. If short bombing is the dramatic public act, then naked shorting is the quiet, shady work happening behind the curtain. This practice allows institutions to sell gold futures without owning or even borrowing the underlying gold. They are selling gold, they do have to drive down the price of a metal that investors believe is scarce, all in a market that pretends to be regulated. It's brilliant. In a way, naked shorting works because the gold futures market doesn't require sellers to prove they have access to physical gold. They can just sell unlimited contracts. This is phantom gold with absolutely no connection to reality. And this is where the illusion deepens. The more gold you can create from nothing, the easier it becomes to control the price of real, physical gold. The entire mechanism depends on one unspoken rule. No one tries to take delivery all at once. If they did, the market would implode so quickly that regulators would have to invent new words for panic. If you track gold price movements long enough, you'll start to notice unnatural drops that look more like someone pressed a button than a natural shift in supply and demand. There are classic signatures to look for. A 2 to 5% crash within minutes. Orders executed in huge blocks far larger than the market can naturally absorb. And no corresponding economic news or shift in physical demand. It's just pure, concentrated downward pressure, the kind that only derivatives can deliver. The examples are everywhere. We see gold crashing immediately after Federal Reserve meetings, even when the announcements should theoretically lift the price. We see gold collapsing seconds after inflation reports show rising prices, the exact opposite of what you'd expect in a free market. We see gold dumping during periods of geopolitical uncertainty, right when investors have historically flocked to safe assets. These are not coincidences. These are not market inefficiencies. These are strategically timed price suppressions, executed by entities with clear motives and the powerful tools to make them a reality. The physical market simply cannot respond that fast. But derivatives can because they were built to. So, why does every drop have a purpose? If central banks supply the illusion of stable currency, then derivatives are the tool used to enforce it. Every sharp drop in the gold price serves a strategic function. It reinforces confidence in fiat currencies, prevents panic during crises, maintains the illusion of monetary stability, protects bond markets, and supports government debt. The goal is to make sure gold never becomes too attractive. Gold must always remain just interesting enough to serve as a hedge, but never powerful enough to challenge the dominance of paper money. Derivatives make this possible. They ensure that gold cannot behave naturally. They turn price discovery into price choreography. They turn markets into stage plays with predetermined outcomes. When the price rises, derivatives push it back. When the price falls, derivatives cushion it just enough. When reality threatens the illusion, derivatives simply drown out reality. This is not a free market. This is a controlled environment where paper governs metal, and the illusion survives because the weapon used to enforce it is invisible to most observers. Hear us, the final paradox of paper gold. The gold market is considered one of the most liquid markets in the world precisely because it trades so much paper gold that physical constraints no longer matter. Think about that. If a market's liquidity depends on assets that don't actually exist, is it a market at all? Or is it just a simulation? Derivatives turned gold from a bar in a vault into a number on a screen. They turned scarcity into abundance. They turned truth into noise. They turned gold, the oldest store of value in human history, into a puppet moved by invisible hands. Physical gold is honest. Paper gold is obedient. And in today's market, only one of them is in control. Guess which one wins? If you thought the story so far was alarming central banks pulling strings in the shadows, derivative markets ballooning into financial weapons, and gold being priced by digits rather than metal, then welcome to the part where everything finally connects, because none of this could function without a system. Structure, a well-designed, airtight, interlocking network whose primary purpose is not fairness, not transparency, and certainly not accurate price discovery. No. The real purpose is much simpler. To maintain the illusion, to keep you believing that the paper markets are legitimate, to convince you that the system has integrity, to make sure you never ask the dangerous question. Is there actually enough gold behind all this? Spoiler alert, there isn't, and they all know it. Let us begin with the most polite way to describe this ecosystem, a network of participants. But let's drop the polite language. What you're really looking at is a cartelic consortium of institutions whose interests are so tightly aligned that they don't even need a smoke-filled room to coordinate. The incentives do the work for them. At the center of this spiderweb are a few key players. First, you have COMEX, the futures playground, where gold's price magically moves up and down, without anyone ever having to touch physical metal. Then there's the LBMA, the London Bullion Market Association. This is the opaque, over-the-counter hub, where trades are so large and so private that transparency is treated like a biohazard. Next are the bullion banks, the giants who write contracts on gold they do UNT, and promise delivery they pray nobody demands at the same time. And finally, you have the central banks. They're the ultimate backstop, the quiet shareholders of the system who lend gold, lease gold, and report gold in ways that make accounting textbooks quietly sob in a corner. Together, they form a seamless chain. COMEX sets the visible price you see on the news. The LBMA operates the massive shadow market behind the scenes. The bullion banks execute the strategies that keep the game going, and the central banks provide the narrative cover. The official story that everything is fine, and you, standing at the edge of the system, are politely told that everything is normal. There's nothing to see here. You might be wondering, why is the gold market the least transparent market on Earth? Even though gold is supposedly a foundation of global finance, you'd think a market that anchors currency confidence, central bank reserves, and global wealth preservation would be audited, inspected, verified, and tripled. But no. The opacity isn't a bug in the system. It's the main feature. Opacity is the mechanism. It's the shield that protects the illusion from collapsing. Think about it. Transparency threatens the status quo. If the world ever learned how little gold is actually available relative to the mountains of paper claims floating around, the system would evaporate like morning fog. Imagine if COMEX actually had to list the real numbers. Things like gold registered for delivery, laughably small. Or maybe open interest claims, multiple times global annual production. And the scariest one, ratio of futures to physical. Please don't look. The entire facade would collapse in an instant. So instead, the system survives through the artful use of delayed reporting aggregated data that hides all the specifics. Audits so limited they're practically ceremonial, and language so vague you'd think lawyers wrote it while trying not to incriminate themselves. This isn't incompetence. It is design. You hear about these mythical London vaults and COMEX warehouses that allegedly contain vast amounts of gold. You see spreadsheets showing tonnage that looks reassuringly large. You hear phrases like allocated, unallocated, eligible, registered, and you assume it all means something precise and secure. But here's the uncomfortable truth. Almost none of it undergoes regular, independent physical audits. And why not? Because the moment you start counting actual physical bars, you risk discovering quantities that don't match the promises made on paper. Consider this: the LBMA does not require full transparency on individual holdings within its vaults. Central banks list their gold as gold and gold receivables, lumping them together as if borrowed gold and owned gold are completely indistinguishable. The data from COMEX is self-reported by the very same entities that benefit from this opaque reporting. And the bullion banks, they rely heavily on fractional allocation, meaning your gold might not actually exist until you demand it. And even then, good luck getting it. And yet, this entire system supposedly underpins trust in global finance. It would almost be funny if the stakes weren't so incredibly high. You'd think that a market built around one of the oldest, rarest, most tangible stores of value would be firmly grounded in physical reality. But you'd be wrong. The modern gold market is a digital hall of mirrors. It's a structure where paper claims vastly outnumber the actual metal ounces. It's a place where the price is set by traders who will never, ever touch a bar of gold in their lives. The vast majority of trades just settle in cash, and demanding physical delivery is treated like a nuisance, an inconvenience, rather than the entire purpose of the market. The paradox is astonishing. Gold, arguably the only universally recognized real money, is traded in a system almost completely disconnected from the real metal. The system depends on you not noticing that contradiction. The illusion requires your trust. The machine functions only if you believe the price you see on the screen is legitimate. And so, the institutions work together, in concert, to maintain the COMEX suppresses transparency by letting contracts roll over indefinitely. The LBMA hides behind excuses about market structure complexity. The bullion banks borrow, lease, rehypothecate, and recycle bars on paper like they're infinite. And the central banks, they remain strategically silent while enjoying the benefits of a controlled price. It's almost poetic if you happen to enjoy dark poetry. At the core of this system lies a simple power dynamic. A handful of institutions control the market, the narrative, and the flow of information. They decide what counts as gold. They decide how much gold exists, at least on paper. They decide the rules of reporting. They decide what is shown to the public, what is hidden, and what is left vague enough to be interpreted conveniently. And most importantly, they decide the price. The public, you were simply invited to observe from a safe distance and accept the numbers you were given as truth. This is how the illusion persists. Central banks want low volatility to protect their fiat currencies from competition. Governments want stable confidence in their monetary systems. Bullion banks want profitable derivative markets they can trade in. The exchanges want trading volume, not honesty. And institutions all around the world benefit from a gold price that looks contained and predictable. Transparency would threaten all of this. A real audit would threaten all of this. Physical verification would threaten all of this. So, naturally, none of that ever happens. The most chilling realization is this. Nothing in this system is malfunctioning. Nothing is accidental. Nothing is disorganized. This is not chaos. This is choreography. COMEX behaves the way it does because that's how it's meant to function. The LBMA hides data because transparency would destroy its leverage. The bullion banks juggle paper claims because that's where the profit lies. Central banks participate because a controlled gold market protects their monetary power. This is a system working perfectly for them, not for you. The illusion remains intact because every single player in the network has a vested interest in maintaining it. And as long as the public believes the gold market is fair, honest, and backed by physical metal, the machine just keeps humming along. The truth is simple, uncomfortably and undeniable. The system was built not to reflect reality, but to disguise it. There's a strange paradox at the heart of modern finance. The more complex and sophisticated our financial systems become, the more ancient the deceptions holding them together seem to be. And you can see this nowhere more clearly than in the global gold market. It's a market that presents itself as the ultimate anchor of value, yet it seems to be drifting further and further from reality. For decades, we've been told a very comforting story: gold is stable. Gold is trustworthy. Gold is the ultimate safe haven for your money. But this entire story falls apart the moment you look a little closer. The price of gold, which is supposed to be this great benchmark of real value, isn't actually a reflection of simple supply and demand. It's not about scarcity or utility. It's not even just about fear and greed. It's a reflection of control. Think about it. The price you see on your screen was decided long before you ever saw it. It's a number that has been negotiated, massaged, engineered, and on some days, brutally enforced by forces you don't see. And by believing in the illusion that this price is natural, the world pays a cost far greater than anyone is willing to admit. When the value of something as fundamental as gold is distorted, it's not just professional traders who get hurt. It's everyone. Because gold is more than just a shiny, yellow metal. It's a measuring stick for monetary truth. It's supposed to be the pressure gauge for financial stress. The silent alarm system that should start ringing loudly whenever governments print too much money, borrow too much debt, or let inflation run wild. But when the price of gold is suppressed, when it's artificially held down or strategically redirected, that alarm system is muted. The world becomes deaf to the approaching danger. Everyday citizens lose one of their most powerful tools to preserve their wealth. They look at gold and think, well, it's underperforming, without realizing that the performance itself is being engineered. Your savings quietly erode as the currencies in your bank account weaken. But there's no natural counterbalance rising to show you what's happening. Inflation seems less threatening than it really is because gold, the one thing that should be lifting the curtain on monetary irresponsibility, is being held down. Economic crises brew beneath the surface. But the messenger, gold, has been told to stay silent. By manipulating the price of gold, the system isn't just managing a number, it's managing our perception of reality. The world loses one of its last objective mirrors, and we all pay for that loss every single day. whether we know it or not. The gold price is meant to be the foundation of our financial world. It's the ultimate benchmark, the reference point for risk, value, and monetary sanity. But if that benchmark is being manipulated, then everything built on top of it becomes distorted too. Think about the implications. Every trade in the gold market becomes a bet, not on value, but on a rigged system. Every government bond that's priced relative to market confidence is actually reflecting a controlled, artificial reality. Every massive liquidity injection by central banks is justified using metrics that are themselves influenced by that same suppressed gold price. Every complex risk model that big institutions use absorbs this lie and treats it as truth. Every long-term contract, every financial promise, every derivative tied to gold inherits this fundamental distortion. In other words, the entire global financial system is balancing on a number that is anything but neutral. It is like building a skyscraper on a foundation of sand and then acting surprised when the whole structure sways every time the wind blows. The very ground beneath our financial world isn't as solid as we're led to believe, and somehow we're all expected to just go about our business, functioning normally on top of this scaffolding of illusions. So, why does this happen? It leads to an uncomfortable feedback loop that very few people in power dare to speak about publicly. If gold were allowed to trade freely, if its price were allowed to reflect the true economic conditions of the last few decades, all the money printing, all the debt expansion, all the currency debasement, the global financial system as we know it would convulse. Why? Because gold is a truth. A rapidly rising gold price would reveal some very uncomfortable truths. It would show that excessive money printing is destroying our purchasing power. It would signal collapsing confidence in the fiat currencies we use every day. It would expose the unsustainable levels of government debt around the world and the deep fragility of the entire system. If gold soared to its natural, unsuppressed price, it would expose the central lie that modern finance depends on. The idea that currencies backed by nothing more than faith in government promises can remain stable forever. And so, the system has no choice but to suppress the signal. Central banks need gold to be quiet, to preserve the credibility of their currencies. Governments need gold to be quiet, to avoid public panic. The big banks need gold to be quiet to keep their mountains of leverage from unraveling. The markets need gold to be quiet to maintain the illusion of stability. Gold must not be allowed to shout. It must not be allowed to warn us. It must not be allowed to reveal the truth. And so the cycle continues. Manipulate the price, which stabilizes the illusion, which prevents the truth from getting out, which necessitates more manipulation. It is a perpetual feedback loop, designed for one purpose: to defend the current structure from its most ancient and powerful threat in its price discovery. And this brings us to the philosophical core of the entire issue. This illusion of a fair gold price persists not because of some brilliant conspiracy, or pure malice, or even raw power, although those things certainly help. It persists because the world has become dependent on it. Without a contained, managed gold price, governments would face incredibly difficult questions from their citizens. Currencies would wobble on the global stage. Debt markets would tremble. And confidence, that fragile, delicate, and absolutely essential ingredient for our entire economy, would crack. The illusion's the glue holding things together. The managed price is the mask. The system survives because facing the unvarnished truth would be, for many, simply unbearable. And so, the world quietly agrees, whether consciously or not, to maintain the fantasy. We pretend the gold market is honest. We accept suppressed signals as natural market movements. We trust a benchmark that's been crafted behind closed curtains. We believe in a number, simply because believing is easier and less disruptive than questioning it. But the cost of this belief is enormous. It's a price we pay in distorted markets, in weakened currencies, in the lost purchasing power of our savings, and in economic cycles that strike harder and more unexpectedly than they should. It's a price paid every time someone buys gold thinking it's stagnant, completely unaware that the stagnation is an engineered outcome. It's a price paid every time a crisis brews just beneath the surface, with no honest indicator left to warn us. The price we pay is not in gold, but in illusions. As someone once said, in a system built on confidence, the greatest illusion is the one the world chooses not to question.